Walk into any major bank in Manhattan or Mayfair, and you'll notice a pattern. The marble is cold, the ceilings are high, and the silence is expensive. Most people walk through those glass doors thinking they are the customer. They think the bank is a vault designed to protect their labor. Warren Buffett thinks differently. To him, a bank is not a vault. It is a mirror. It doesn't reflect your value as a human being, but it reflects exactly how the system intends to harvest you. The bank has a script for you. They've had it for 100 years. Whether you have $50 in a jar or $50 million in a trust, the bank knows exactly which version of the script to read. If you don't know which level you occupy, you aren't playing the game. You are the prize. Today, we are going to dissect the 8 levels of banking wealth. We are going to see how the system shifts from being your predator at level 1 to your polite salesman at level 4 to your silent co-conspirator at level 8. Most importantly, we will reveal the Buffett countermove, the simple strategy the world's greatest investor used to stay at the top while everyone else was busy paying for the bank's mahogany furniture. At level 1, you are effectively invisible to the bank's management, but you are highly visible to their algorithms. This is the extraction stage. In the United States, there is a silent tax on being poor. If your balance dips below a certain threshold, say $1,500, the bank doesn't see a person struggling with inflation. They see a maintenance fee opportunity. They charge you $12 to $15 a month just for the privilege of letting them lend your money out to someone else. Then comes the overdraft humiliation. If you spend $5 on a cup of coffee but your account has $2, the bank will graciously allow the transaction to pass and then hit you with a $35 penalty. Mathematically, that is a 700% interest rate for a few hours of credit. Buffett calls this the sunk cost of survival. At level 1, the bank's goal is not to help you grow. It is to automate the extraction of your marginal capital. You are the fuel that powers the free checking accounts of the wealthy. You are not a client. You are a profit center for penalties. The compound wisdom insight. If you are at level 1, your primary enemy isn't the stock market. It's the leakage. You cannot compound a bucket that has holes in the bottom. Your first move isn't investing. It's finding a credit union or a digital bank that doesn't charge you for the crime of being a beginner. Congratulations, you've saved your first few $1,000s. You no longer pay maintenance fees. Now the bank changes its mask. You have graduated from being invisible to being a target. This is where the credit card offers start arriving. They look like gifts. 0% APR for 15 months, 50,000 bonus miles, and gold status. At level 2, the bank is betting on your psychology. They are weaponizing what Charlie Munger called the envy-driven economy. They want you to use that $10,000 credit limit to buy things you don't need to impress people you don't even like. The bank knows that if they can get you to carry a balance, even just once, they have you. At 22% interest, your debt doubles every 3.2 years. They are essentially selling you your own future at a massive markup. At this level, they'll offer you a personal banker. This is a 24-year-old in a polyester suit whose only job is to cross-sell you. They'll try to get you to open a high-yield savings account that pays 0.5%, while the bank lends that same money out for car loans at 7%. The Buffett rule. Warren Buffett bought his house in 1958 for $31,500 and still lives there. He didn't use his early wealth to level up his lifestyle. He used it to buy his freedom. At level 2, the bank wants you to lease a BMW. Buffett would tell you to buy the index fund and drive the old Chevy. Level 3 is where most of the American middle class lives and dies. You have a stable balance. You have a direct deposit that hits like clockwork. You have a 401k that is starting to show real numbers. To the bank, you are now the reliable cog. You are too wealthy to be bullied with fees, but not wealthy enough to be given the good stuff. This is the stage of polite indifference. The bank will give you a mortgage, but they will sell that mortgage to Fannie Mae within 48 hours. They will give you a car loan, but they will bundle it into an asset-backed security. The danger at level 3 is the identity shift. You start feeling like a client. You start listening to the bank's financial wellness seminars. They'll encourage you to keep $50,000 in a premier savings account. What they don't tell you is that $50,000 is losing value to inflation every single day. The bank is using your safety net to fund their own aggressive investments. The compound wisdom insight. This is the level where the silent killer lives, opportunity cost. For every dollar sitting in a 0.1% savings account while the S&P 500 is returning 10%, you are paying the bank a stupidity tax without even knowing it. This is the most dangerous level in the entire hierarchy. You have reached a point where you have discretionary capital. Maybe it's a house sale, an inheritance, or a decade of disciplined saving. The bank now triggers the mahogany desk trap. You are invited to the priority suite. The coffee is better. The chairs are leather. You are assigned a relationship manager. Be very careful. In the world of finance, if you don't know what the product is, you are the product. Your relationship manager is not a fiduciary. They are salespeople with a quota. They will look at your $300,000 and tell you that you are sophisticated. They will suggest proprietary mutual funds or actively managed portfolios. These funds often carry a 1% to 1.5% management fee. To the uneducated, 1% sounds small. But over 30 years, a 1% fee will eat nearly 1/3 of your total wealth. Warren Buffett famously won a $1 million bet against hedge fund managers by proving that a simple, low-cost S&P 500 index fund would beat the sophisticated managed funds of the banks. The system villain. The bank doesn't want you to know about index funds. They want you in their wealth management wrapper so they can clip a piece of your harvest every year, whether the market goes up or down. At level 5, you have hit the accredited investor threshold. You are now officially a high net worth individual in the eyes of the SEC. The bank's tone changes from selling to consulting. They start talking about tax efficiency and estate planning. This is the level of the illusion of exclusivity. They will offer you private equity opportunities, deals that are not available to the general public. They make you feel like you've been invited to an elite club. But here is the quiet truth. Most private equity offered to people at this level is the leftovers. The truly great deals are reserved for the level 8 billionaires. You are being sold the feeling of being rich while the bank takes high performance fees, the 2 and 20 model. The Munger lens. Charlie Munger always said, "Show me the incentive and I will show you the outcome." The bank's incentive at level 5 is to move your money from simple liquid assets like stocks into complex illiquid assets like private REITs. Why? Because once your money is locked up, you can't leave. You are now a captured client. At level 6, the bank finally stops trying to take your money and starts trying to help you keep it. Why? Because at this level, you have enough leverage to walk away. This is the level of the Lombard loan. Let's say you have $5 million in an S&P 500 index fund. You want to buy a $1 million vacation home. A level 3 person would sell their stocks, pay 20% capital gains tax, and buy the house. A level 6 person does the Buffett move. The bank will give you a line of credit backed by your stocks. They'll charge you a tiny interest rate, maybe 3% or 4%. You get the $1 million, you keep your stocks compounding at 10%, and you pay 0 taxes because you haven't sold anything. The bank becomes your partner in the great accumulation. They treat you with genuine respect because you are now a source of assets under management, AUM, that they can use to borrow more money from the Federal Reserve. At level 7, the bank doesn't send you mail. They send you a person. You are in the private bank or a multifamily office. This is the level of structural engineering. The bank will help you set up trusts in South Dakota or offshore entities in the Caymans. They will provide concierge services. If you want a private jet for the weekend or a rare bottle of wine delivered to a yacht in Croatia, the bank handles it. But there is a trap even here. It is the complexity trap. The bank will try to sell you structured products and derivatives to hedge your risk. Buffett called these financial weapons of mass destruction. Many people at level 7 lose their wealth not because they spent it, but because they allowed the bank to make their lives too complicated. They get lost in a sea of alternative investments that have high fees and zero transparency. The Buffett countermove. When Warren Buffett became a billionaire, he didn't hire a massive army of private bankers to manage his personal cash. He kept it simple. He stayed focused on his circle of competence. He knew that the more layers you put between yourself and your money, the more people are reaching into your pocket. At level 8, the relationship is inverted. You don't have a banker. The CEO of the bank has you on speed dial. You are no longer a client, you are a strategic partner. You participate in IPO allocations. When a company like Airbnb or Snowflake goes public, the bank gives you shares at the strike price before the general public can buy them. This is an almost guaranteed pop in wealth. You have access to institutional rates. You can borrow hundreds of millions of dollars at rates the average person can't even dream of. But here is the final secret of the compound wisdom. The most successful people at level 8, the Buffetts, the Mungers, the Bezoses, they don't act like they are at level 8. They understand that the banking hierarchy is a game of net value. The bank wants you to climb the levels so they can increase their share of wallet. But your goal is to stay as low maintenance as possible. The compound wisdom secret is this: act like a level 1 saver with the tools of a level 8 owner. Keep your costs at zero. Avoid the salesman in the leather chair. Use the bank's debt only when it creates more assets. And never, ever let the bank convince you that complexity equals safety. The banking system is designed to be a one-way valve. It wants to suck wealth out of the bottom levels to provide bespoke services to the top levels. If you are at level 1 or 2 today, your job isn't to pick the next hot stock. Your job is to stop the bleeding. Kill the fees. Kill the 22% credit card interest. Become invisible to their extraction algorithms. If you are at level 4 or 5, your job is to resist the ego trap. Don't be sophisticated. Be rational. Fire the manager who is charging you 1% to underperform the market. Warren Buffett spent 99% of his life in a simple office in Omaha, Nebraska. He didn't need the mahogany desks or the private banking concierge to become the wealthiest man in history. He just needed time, compounding, and the discipline to stay out of the bank's traps. Which level are you at today? And more importantly, which level are you aiming for next year? Drop your level in the comments below. I want to see how many of you are ready to break the hierarchy. If you found this valuable, you'll want to watch our deep dive on the 1% wealth rule. It explains exactly how Buffett turned his first $100,000 into a machine that the banks could never stop. Build the wisdom. Compound the truth. See you in the next one.